Most retirement tax plans fail, not because the math is wrong, not because the advisor is incompetent, but because they're built on a fundamental assumption that's completely backwards. And if your retirement plan is making the same mistake, and there's a good chance it is, you're going to pay tens of thousands, maybe hundreds of thousands more in taxes than you should. Today, I'm going to show you exactly why most tax plans collapse the moment you retire, and what wealthy retirees do differently. I'm Mark Wisniewski with Southern Incomes. I've spent years helping retirees navigate the tax minefield between retirement and age 80. And what I've learned is this: the conventional approach to retirement tax planning, it's designed to fail. It looks good on paper, but it falls apart in reality. Today, I'll walk you through 3 reasons your tax plan is probably broken and the strategy that actually works. Mistake number 1, the wrong assumption. Here's a mistake almost every retirement tax plan makes. They assume your income is going to be lower in retirement than when you are working. And based on that assumption, they tell you to defer taxes now and pay them later on when you're in that lower bracket. That's the entire foundation the traditional 401k and IRA is based on. Defer, defer, defer. Pay taxes later. But here's the problem. For most retirees, income doesn't drop the way that everyone thinks it will. Let me show you what actually happens. You retire at 65. For the first few years, your income might be lower. You're pulling from savings, maybe some part-time work. Social Security hasn't started. RMDs haven't kicked in, so your taxable income looks low. Your advisor sees this and says, "Great. You're in the 12% bracket. The plan is working." But then you hit 70. Social Security starts. Now you've got $40,000, maybe $50,000 in Social Security income alone. Then you hit 73. Required minimum distributions. RMDs kick in. Now you're forced to pull $50,000, $60,000, maybe $80,000 from your IRA every single year, whether you need it or not. Add in pension income, investment income, maybe some rental income. Suddenly, you're right back in the 22 to 24% bracket, sometimes even higher. And here's the kicker. You're paying tax on every dollar of that RMD. Plus, you're paying tax on up to 85% of your Social Security. Plus, you might be triggering RMAA surcharges on your Medicare premiums. The low tax retirement you were promised, it never materialized. Mistake number 2, the wrong sequence. Here's the second reason most tax plans fail. They follow a rigid withdrawal sequence that sounds smart, but it ignores reality. The conventional wisdom is simple. Spend your taxable accounts first, then your tax-deferred accounts, then your Roth accounts last. The idea, you want your Roth growing tax-free as long as possible, so save it for the end. But the strategy, it has a fatal flaw. By spending taxable accounts first and leaving your IRA untouched, you're allowing that IRA to grow bigger and bigger, which means your RMDs at 73 are gonna be massive. And those massive RMDs push you in the higher brackets, trigger Social Security taxation, and create RMAA surcharges. I've seen retirees with $1.5 million in their IRA at age 62 following that textbook sequence, only to discover that by age 75, their RMDs are $70,000 a year and they're getting crushed by taxes. They followed the plan perfectly. The plan destroyed them. Here's what makes it worse. They could have avoided the entire problem by doing small strategic withdrawals from their IRAs in their 60s when their income was low. They could have converted portions to Roth when they're in that 12 or 22% bracket. But their advisor told them, you need to wait. Now they're stuck. Mistake number 3, one-size-fits-all models. Here's a third reason tax plans fail. They're built using Monte Carlo simulations or maybe some probability model that treats every year of retirement exactly the same. But your tax situation is not the same every year. And if your plan doesn't account for that, you're leaving massive amounts of money on the table. No doubt about it. Think about this. You might have a year where your income is unusually low. Maybe you retired mid-year, or you had a big medical deduction, or you took a capital loss. That's a golden opportunity to do a large Roth conversion at the low rate. But most plans don't account for that. They don't flag it. They're running at a 30-year average and ignoring the year-by-year opportunities. Or maybe you have a year where your income spikes. You sold a property, exercised stock options, or you just had a big bonus. That's a year where you should do 0 Roth conversions and focus on, tax loss harvesting, or maybe do your charitable giving. But most plans don't adjust. They just follow the script. The wealthy retirees I work with, they treat every year as a unique tax puzzle. They're not following a rigid sequence. They're adjusting based on income, deductions, life events, tax law changes, and that flexibility saves them 6 figures over retirement. Now, if you're sitting here and thinking, oh no, I've been following that traditional plan, now I think I'm headed for a tax disaster, you're not alone. This is exactly why I work with retirees at Southern Incomes to build dynamic tax strategies that adapt to your real life, not some textbook model. Link in the description to book time with me. What wealthy retirees do differently. Strategy number 1, think in brackets, not account types. Instead of asking, well, which account should I withdraw from now? They ask, how much room do I have in my current tax bracket, and how do I fill it strategically? If they're in the 12% bracket with $20,000 of room before jumping to 22%, they might pull $20,000 from their IRA and convert it to Roth, even if they do not need that income. They're using that bracket space because it's cheap tax real estate. Strategy number 2, front load that tax bill. This sounds counterintuitive, but hear me out on this one. Most people try to minimize taxes every single year, right? Well, wealthy retirees are willing to pay more tax in their 60s if it means paying way less in their 70s and into their 80s. They do Roth conversions early on in the 12 and 22% bracket, so they can avoid the 24, even the 32% bracket later on when those RMDs hit. They're not just minimizing annual taxes, they're minimizing lifetime taxes. Strategy number 3, use multiple income levers. They don't just pull from one account and call it a day. They pull $30,000 from a Roth, $25,000 from taxable, $15,000 of capital gains, and maybe $10,000 from an IRA. They blend the sources to stay in that target bracket. It's kind of like mixing ingredients in a recipe, right? You adjust your proportions to get the outcome that you want. Strategy number 4, coordinate with Social Security and Medicare. They know that Social Security claiming age affects taxation. They know that RMDs thresholds are going to create cliffs. So they're timing Roth conversions around those decisions. Maybe they delay Social Security all the way out to age 70, and then they do aggressive conversions from 65 to age 69 while their income is low. The point is they're integrating everything. Strategy number 5, plan for the widow's tax trap. Here's something I'd say almost everyone misses. When one spouse dies, the survivor goes from married filing jointly to single. And the single tax bracket is half the size of married brackets. So if you're in the 12% bracket as a couple, your surviving spouse might jump to the 22 or even the 24% bracket on that same income. Wealthy retirees plan for this. They do Roth conversions while both spouses are alive. So the survivor has tax-free Roth income later on. So why isn't everyone doing this? Here's the truth. Most advisors are trained on asset accumulation, not tax-efficient distribution. They know how to grow your portfolio. They know how to rebalance your portfolio, but they do not specialize in the tax side. And if they're not charging for tax planning, if they're just charging you some kind of fee, they don't really have any incentive to spend hours running projections and optimizing your taxes. Why is this? Because this kind of planning is hard. It requires software, it requires coordination with your CPA, it requires annual updates, and most advisors just don't want to do that work. But the cost of that laziness is enormous. I've seen retirees overpay by $200,000 in lifetime taxes because nobody was actively managing the tax side of their plan. And that's not a typo. $200,000. gone because their advisor and more their CPA are on autopilot. The bottom line, most retirement tax plans fail because they're built on outdated assumptions, rigid sequences, and one-size-fits-all models. They assume your income will drop. They assume you should spend taxable accounts first. They assume every year is the same. And all three of those assumptions are wrong. The wealthy retirees who avoid this trap, they think in brackets, not accounts. They front-load tax planning to minimize lifetime taxes. They use multiple income levers. They coordinate Social Security and Medicare. And they plan for that widow's tax trap. That is not the traditional approach, but it's the approach that actually works. If you spent 30 or 40 years building wealth, you owe it to yourself to have a tax plan that's just as sophisticated as your investment plan. Because the difference between a good tax strategy and a bad one, it's not 1 or 2%. It's 6 figures, and you do not get that time back. If you want help building a retirement tax strategy that actually works, one that adapts to your real life instead of just following some textbook script, book a time with me using the link in the description. I'll walk you through exactly where your current plan is leaving money on the table and what you can do about it. Let's make sure you keep more of what you've earned. Thanks for watching, and I'll see you in the next one.